Hey guys, and welcome back to another episode of my Let's Discuss series. Today I'm going to be talking a little bit about an investing strategy that many of you may be familiar with, but some of you may not be, and that is the dogs of the Dow. It's kind of an investing strategy that people use to generate a little bit more dividend income, passive income in any given year. So I'll kind of cover that for the majority of the video. But first thing first, if you enjoy my content, please like and subscribe. I really appreciate all the support. If you haven't already, check out my video this week for the M1 journey. Covered some interesting topics there in regards to cryptocurrency and shared some of my thoughts. So check that out if you haven't yet already. That's about it for news. So let's get ready to discuss the dogs of the Dow. So I'll kind of start off by saying a little bit about what exactly the dogs of the Dow mean, what exactly they are. So the dogs of the Dow is an investing strategy that some people use to generate a little bit of a higher dividend yield or a dividend income in any given year. The dogs of the Dow are decided based off of them being the top 10 highest yielding stocks within the Dow Jones Industrial Average. These fluctuate year to year, of course, based off of performance, and generally they're called the dogs of the Dow because if they are higher yielding stocks, that generally indicates a little bit lower performance or something that doesn't match the rest of the stocks within the Dow. So like I said, depending on how an individual company performs in any given year, it could be a dog one year, and then if it has a good year, it could leave the dogs of the Dow. Although if they're kind of towards the top of the list, they're probably going to stay there at least for a couple of years, or unless they cut their dividend. This is generally a pretty acceptable investing strategy because even though these are higher yielding stocks, they're all considered to be relatively safe. If they weren't safe, they definitely would not be in the Dow Jones, since the Dow Jones is only 30 companies total. So even though they're probably the riskier of the Dow stocks, they're definitely not a whole lot more risk involved than any other investments you may be making, and depending on your situation, could be an appropriate investing strategy for you. So the first question you might be asking is this a worthwhile investing strategy for me? And I would say that kind of depends on a couple of factors. What your investing strategy is, what you expect out of your investments. If you're a person who looks for low volatility in your investments, then this may not be the best course of action for you. Not to say that these are really volatile stocks, because they generally are not. But they are the stocks that generally do underperform the rest of the market in any given year. So with that being said, though, they are stocks that probably could be looking for a little bit of an upswing. If they're a little bit beaten up one year, they could kind of come back a little bit the next year. And that's generally why people look to do that, because these are high quality stocks. So if it has one bad year and then goes on to the next year, it could come back and make up some of those losses, and that's why people like to get in. It's not something I personally pursue. Some of the companies I'll talk about a little bit later are companies that I do own, but I don't own them for the reason because they are just dogs of the Dow. But that is something I keep in the back of my mind. So if I had to answer the question, is it worth it? I would say generally probably not. Now it's a perfectly acceptable strategy, especially if you're more of a hands-off investor that don't really mind fluctuations, but you still like very solid yields rolling into your account in the form of dividends. Now, if that describes your investing strategy, then this might be right up your alley and perfectly aligned with what you want. But my final answer for that would be probably not for most investors, and but it still does appeal to a small select few. So this year's 2021 dogs of the Dow are largely the same as the 2020 dogs of the Dow. There wasn't much change in the list from 2020 to this year. So in order from highest yield to lowest yield, I'll kind of list them off, kind of give a thought or two about each one. The first one and the highest yield of the bunch is Chevron. Chevron is a huge company, huge energy company that largely struggled in 2020 due to the pandemic and other factors. Chevron offers a dividend yield of about 5.5%. I would caution anyone who looks into the energy sector right now. Although it's been on a steady climb for the last couple of months, I would still say there's a little bit of risk still involved there. But generally, I would say Chevron's a pretty safe company. The next one is IBM. IBM is a stock I'm personally invested in if you have kept up with the channel. I like IBM. They're a good, solid company, but they have not been without their faults, especially in recent years, and their dividend yield is about 5.1%. The next one is Dow Incorporated, the major chemicals company, especially in the material sector. They're a major player. I don't know as much about Dow. I'm not invested with them personally, but I know they're a good company, and they're one of the newest additions to the Dow Jones. And their dividend yield is currently about 4.6, 4.7%. Verizon is the next one at 4.4% dividend yield. Verizon is a very good company, major telecommunications, I believe the largest in the world. They're another company that I am personally invested in, and I would say generally is probably a solid investment for anybody. Next is Walgreens. Walgreens has been around forever as a brick and mortar pharmacy and grocery store, kind of a jack of all trades. Their stock was really beaten up in 2020, but they, like many of these others, have seen kind of a resurgence in the last couple of months, and their dividend yield is 3.8%. 3M is next. 3M is one of my favorite companies. In fact, a couple weeks ago I made a Let's Discuss video regarding 3M. I think 3M is a very safe buy, and their dividend yield is 3.5%. Next one is Coca-Cola. Coca-Cola is another company that I personally own. I think they really need no introduction. Pretty much everyone's going to know about their business, and their dividend yield hangs around 3.3%. The next two may be companies that most people maybe not off the top will be as familiar with. That's Merck. Merck is a pharmaceutical company, really one of the largest in the sector. I am not personally invested with them, but I know many people that are, and they're a very solid company with solid growth potential still left, and they offer a dividend of 3.16%. Lastly is Amgen, which is actually the company I know the least about. They are a biotech company. I want to say they were just added to the Dow Jones just this past year, and their dividend yield at current prices is about 3%. I don't really know if they're a buy or not. I'd have to look into it a little bit more, but I assume if they're in the Dow, they must mean they're pretty good. So if you do wish to invest in only the dogs of the Dow, say you had $1,000 and you wanted to put the 1,000 equally in all 10 of these stocks, so you put 100 in all 10 of them, your dividend yield over the next year, or at least at current prices, will look to be about 4.25%, which is a very high yield. My portfolios usually yield anywhere from 3 to 3.3%, so that's about a full percentage point higher. But of course, you are looking at a little bit of a dampened growth potential. Over the last year, these 10 stocks are down 5.7% combined, but things have been looking up, especially over the last quarter, much like every other stock in the markets. And over the last quarter, they are up a combined 10%, so a very solid return there. So that's kind of covering the dogs of the Dow. Pretty easy concept, pretty simple, and many of you may apply it to your own investing strategies, but I personally do not seek that. But like I said, it depends on your own individual circumstances, and I would definitely say it's a more than acceptable investing strategy for anybody. So I'll get into my final comments and wrap up the video. So of course, guys, this goes without saying that I'm not a financial expert. I'm not a financial advisor. Any thoughts you hear me share are strictly my own. Please do your own due diligence and research before making any investment decisions. I cannot stress that enough. But if you guys have an investing topic or a particular stock that you would like me to discuss, please leave those down in the comments. I like hearing your guys' feedback. And if you have any other thoughts, especially considering the dogs of the Dow, please let me know. Just anything you want to say, I'm more than happy to look at it. With that being said, I hope you enjoyed the video. Press that like button if you enjoyed it, and I will catch you guys on Monday.